following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, welcome back once again to Volatility Views, your weekly source for all things volatility-based. My name is Mark Longo from the OptionsInsider.com, as well as the ever-expanding Options Insider Radio Network. And I am joined today on the Volatility Views panel, starting off by my boon companion, the yin to my yang, the premium seller to my mostly premium seller. So once in a great while buyer. Good old.
Not much variety there.
Yeah, that's true. Good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Thank you. Always fun to be here. Looking forward to today's show. We have a premium buyer in our midst, so I'll let you introduce Andrew.
Yes, we have to be careful. We do have a degenerate premium buyer lurking. I think he's on the wrong show, Don, quite frankly. Of course,
I took a wrong turn on the radio somewhere.
Took a wrong turn broadcasting all the way from the great state of Maine. He is none other than Andrew Giovinazzi from optionpit.com joining us today, and he is indeed the most degenerate of all premium buyers. Of course, as I was joking with him before the show, he has a relatively unique characterization in that he always tends to find a way to buy juice for free. Maybe that should be the name of your book, Andrew, Free Juice. How about that?
I know, free juice. I know. I had because I use a wine. I use a lot of in our education classes, and I use a tank of wine as an example for Theta. Don would love this one. It's right up his alley. He would just put his head under the tank, open the spigot, and have all the Theta pour into his coffers, like he is apt to do. But
sounds like an excellent image to me.
Yes. So she says, "Oh, Andrew, now I know why you call it the juice. It's because it's grape juice, fermented grape juice." And I'm like, there you go.
All right, and with the team assembled, we're ready to dive into some volatility action with our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective and see what the markets had in store for us and indeed have in store for us today. As we're recording this show, we have a bit of a dichotomy in the old marketplace. The S&P and the Dow both up about 0.5%, and the NASDAQ, ever the laggard these days, down about 0.5% as well. Most of that being pulled to the dark side by good old Apple, which has sold off even more since we started the show, nearly 3% now on the day. And of course, the VIX cash drifting to the downside as well. You gotta love that weekend love taking it all out of there, even though there are some sell-offs lurking in the wall, and of course there is that weekend risk we talked about many times. Perhaps we'll start there, Andrew. Give us your perspective, your look back on the week's worth of volatility action in the land of VIX.
How about this is the week that nothing happened? I think the VIX gyrated between the 16 handle and the 16 handle, maybe 16. I think it traded 1675 maybe. D's future underwater the whole time, possibly waiting for the unemployment report. Now it's drifting right back up to value, I think. But for all week, you could buy VIX call spreads, things like that, pretty darn cheap. And we're finally seeing VIX cash and future at parity. So, and actually, we didn't have a full. We were long some, but we're having some VIX butterflies on. But
yeah, we had a weird scenario. We had a weird scenario there for a little bit this week, where the futures were actually a bit below the cash, which is not a usual scenario.
50 cents, actually.
That's a substantial amount.
It was huge. You could buy calls in the VIX for nothing. So I mean, I probably should be unwinding it right now, but
you have more important things to do, Andrew, like being on this show right now.
That's why I do less now, because I end up doing these things, and I'm like, oh, I have a position on. Maybe I should.
Welcome to my world, sir.
But be that as it may, we did tell our option pit clients. We gave them the out this morning. Just tell them to be cognizant of it. But yes, we've had a very strange week in volatility. I think, and the continuing, really, the vol bulge, if you look at it, is kind of right around the fiscal cliffy January, that first week in January, where the volatility is going to all the activity is going to gravitate toward it. You got to be realistic. And everything else is going to kind of slowly dissipate except for that. So I don't expect a lot of actual real swings in VIX cash between now and then, unless the nincompoops can come to some sort of reasonable way to cut the deficit. It's $1 trillion. It has to go away. So raise revenue and cut spending. But I don't think they're going to do that anytime soon. So the VIX is going to go nowhere because. I think if the easiest way to look at this situation was, I think, we had the Greek vote right around the June expiration cycle, where that front month vol stayed kind of elevated, even though nothing was really moving. Obviously there's certain types of positions for that, and then you kind of had sort of the relief rally after the Greeks voted basically to sort of stay in the euro. And that was, I believe, the end of volatility for the year as far as the high numbers went, was that vote. And probably the same thing will happen if we can get some resolution on any kind of path for it. And I think the vol, will probably be headed down again. But till then, I am not a buyer. I'm not a seller at this level. Everything's pretty. A lot of basically just any trade is more like things are going to go sideways till at least the end of the month.
You think this odd confluence of events we're going through right now is the primary reason why we ended up with this odd scenario of the near-term VIX futures trading below the cash? I mean, we've been doing this show forever. We've always been talking about term structure and the price and how expensive it is to buy any real protection out in VIX land. And then we have this odd scenario this week where I'm trying to remember the last time that occurred. It's been some time.
Mark didn't have a bad thesis about, the unemployment number, if it was still going to be relevant or not. And it looks like that was part of the reason. Because normally when things are like a little backward, when the cash is just backward with the one future, you're expecting some kind of movement. So they were kind of pricing because what really was happening is like the options were almost being pulled up artificially, I think. Because let's say if we had a bad unemployment number, we crap out 1-2% or something like that. I mean, the market really needs an excuse to really sell off good. And an unemployment number, maybe when they adjusted the other 2 months or something like that, the other two numbers we had. But it didn't happen. So maybe we can thank Sandy for that. Who knows what the deal is. And now things are kind of coming a little back into line, and everything is focusing on, the end of the month. And I think this is one time a juice buyer would say, if you're buying juice between now and the end of the month, I think you're going to, it's going to be expensive. Let's just put it that way.
Yeah, it's a few things happening this month, unlike previous years, where the end of the year is pretty much a very quiet period. We, of course, have the ridiculous, you can't even call it a cliche anymore. It's gone beyond cliche now, of the fiscal cliff. But you have that looming. You have, of course, many, many names moving up their dividends or creating special dividends to get their dividends out in 2012 as opposed to 2013 to avoid different tax consequences. There's a lot of events. Of course, Greece and Europe. There's a lot of events actually swirling in the ether right now, where typically this part of December is usually getting into a very, very quiet period, except for a few people closing out positions for tax purposes. purposes. So yeah, unusual to have this much juice in the vol going into the end of the year there. Speaking of juice and vol, we're also seeing an active day from a NASDAQ perspective, as I mentioned earlier. So Don, what has caught your eye in the week worth of the index that I shall not call NAPL Plus?
Well, of course, just today we do see NASDAQ breaking from the ranks of S&P and Dow. Not that either one of those two is up dramatically today, but they're in the plus column and NASDAQ is down primarily because Apple continues to be under pressure. But I just can't get away from the environment that, Andrew kind of prefaced his remarks by saying that this was basically the week that wasn't in volatility terms. And 1 month S&P trailing historical volatility is now down to 14.2, which is a full point lower than on our show last week. And even NASDAQ is down into the 16 handle, 16.6, which is almost a full point lower than at this time last week as well. So it certainly has been somewhat of a premium seller's dream in terms of the week, because in addition to the fact that implied volatility seemed to be going nowhere, the actual market volatility is going nowhere also. If you're an options trader and you're selling straddles or strangles and you're looking to collect theta and try to make money in that fashion, there are, of course, two ways that you do that. One is to hope for lower premiums through lowering implied volatility. But another, which is almost in some instances more powerful, is to simply have the market go absolutely nowhere like this for a week or more at a time, so you don't have to make any adjustments, do any delta neutral hedging, have any kind of follow-ups, and just sit there and, as I like to joke, listen to the options decaying. You can hear the time premium, So basically, it's been that kind of a week. And I commented last week that sometimes a measure of this complacency is actually not just the pure volatility term itself, but the next component, the volatility of volatility, or whether that volatility number is even budging or moving around at all. And we had those striking numbers last week for 1 month vol of vol, 71 for S&P and 47% for NASDAQ. That's absolutely unheard of. 47% is just the regular volatility of equity sometimes. This is the volatility of volatility, which is usually a number close to 100 for the 1 month indices. And we're looking at 47 on the NASDAQ, levels that have not been seen in close to 20 years. So I'm not saying that will persist or that something like that can keep up, but simply commenting that that's the kind of regime or environment that we are in right now.
All right, thank you for that, Don. And like we said, it's some interesting action in both ends of the spectrum. Perhaps a little more in VIX than there was in NASDAQ last week, but perhaps that will change next week with next week's show.
I have a name for this, by the way.
What's that?
I'm going to call this market activity the Zimbabwe effect.
And why is that?
That's when your political class is in a race to turn your country into Zimbabwe. Nobody knows what to do.
There we go.
You keep the ball bid and it doesn't go anywhere.
Before we get too far down the political rabbit hole, I think we'll close out the volatility review for this episode and dive into our oft-requested, much delayed, but back by popular demand, listener mailbag.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the listener mail segment. This is, of course, the portion of the show where you, the listener, gets your chance to sound off and chime in on the old Volatility Views program. We have a lot of you joining us with a lot of interesting comments and questions. First off, we'll just dive right into them because we have some interesting ones. A lot of you wanted to talk about a ongoing point of discussion on this show. We've been hitting on very much on the last episode, but of course, even the episode preceding that, where we discussed Nassim Taleb, but we've actually been debating on the show how we're even going to pronounce his name. There's been some back and forth on how the actual proper pronunciation of his name. We decided on Nassim Taleb. Of course, I think that's a very fluid pronunciation. We'll probably have it changed again next week as someone writes in with the proper pronunciation of his name. But regardless, there's been a lot of back and forth amongst us here on the show and, of course, with you, the listeners, regarding that topic of the Black Swan event and whether or not that is warranted in this scenario, and how, of course, tail risk and all of the various discussions we've had on that on this show over the past year or so. So we'll dive right into it here with a comment, first off, by Teddy that he posted on our Options Insider comment system regarding what we were discussing a couple weeks back about Taleb, I should say, and why he was wrong about markets and uncertainty. He writes, "This is a great article. I certainly hope you guys, I really hope you guys discuss this on the next episode of Volatility Views." He also writes, "I'm curious about this new low vol VIX. What is the point of it?" Maybe we'll hit the low vol VIX first, because I have a feeling the other conversation will be lengthy and involved. So maybe we'll hit on that. Of course, last week we had a special guest, so we didn't have time to discuss some of the breaking news that was going on in the world of volatility last week, which was, of course, the announcement of this new quote-unquote low-vol VIX product coming out of the SIBO. And if you haven't been paying attention to this, what this really is a combination of two of SIBO's existing products, the Buy Right Index, or the BXM, and a VIX Tail Hedge Index. And it's going to be a weighted index. It'll be 60-40, 60 for the VIX Tail Hedge, 40% for the Buy Right. If you're not familiar with those individual components, the Buy Right replicates owning the SPX and then writing a front month at the money call against it. The VIX Tail Hedge is essentially just a 30 delta VIX call for the most part. So they're combining those two existing products into one index, you can call it. I don't think it's not going to be a tradable product right away. It's going to follow the path of a lot of other recent announcements over there, and that'll probably be something we can keep an eye on first, and they'll disseminate numbers from, and then it'll go from there. But it's interesting in a number of levels. I don't know, Andrew, have you been following this at all?
No, I just started looking at it a little bit. So it's a way to buy cheap skew, basically. Is that what you're kind of doing?
It's a strange beast. You know what it replicates by combining the two. It replicates owning the S&P 500, owning the SPX, writing that same front month at the money call against it, and then also owning a out of the money VIX option, a roughly 30 delta VIX option. So essentially, what they're looking to do is
like give a collar.
Exactly. It's kind of it's a modified collar in many senses. It's essentially replicating owning the underlying, generating some income, and then if you're also concerned about downside, instead of doing the straight up collar put in the S&P or the SPX, you go off and pick up an upside VIX call. So it's interesting. We've had some people writing into us with confusion about why a low volatility index. I admit the name threw me for a loop at first as well. I didn't know if this was something where you could speculate on low vol or what this was going to be. The name is actually kind of contradictory because both of these positions actually fare better in a high volatility environment. So the notion that
I'll tell you what my take on it is, Mark.
Sure,
maybe I'm wrong, but this is my take. If you own an equity portfolio, just straight stock, straight equity, you can chart the volatility of that holding. If you instead were to have a buy right where they are contradictory positions because you're long the stock but you're short a call, and therefore when one goes up, the other goes down, when you combine them into a single position, the volatility of a covered right as an entity therefore becomes lower than the volatility of holding the stock portfolio. And if you were to add a long put to that about the concept of the collar that you mentioned before, or a surrogate for a long put, which is a VIX call, which obviously then also goes in the opposite direction, because if stocks go up, volatility usually drops, and therefore the value of your call drops along with it, you have these offsetting positions so that if you track the volatility of the entire package or the entire concept, you come up with lower volatility than just a pure equity holding by itself. Now, having said that, what kind of an investment is this? Well, collar buyers, because of the skew, actually get the worst of it when they do it with pure S&P options or with index options, because they're buying puts that are below the market and therefore higher implied volatilities as you go lower. And they're selling calls above the market, also out of the money. And that's the right-hand side of the skew, where implied volatilities are lower than the at the monies. So you get retail or the public or even hedge fund managers putting on these collars purely with S&P options, where they're getting the worst of it on both sides in terms of the premium. They're buying the high implied volatilities and selling the low. And the sell side, the investment banks who are providers of liquidity, are only too happy to take the other sides of these trades, then delta neutral hedge them with futures or with equity positions of their own, and try to play that differential in the skew and the implied volatilities to their benefit. The only other comment that I can make at the end here is, so instead of owning the S&P put or the other side of the collar, you're owning instead a VIX call, which behaves similarly and serves the same purpose, but which has astronomical implied volatility, because this is now, the volatility on a volatility product, and the implied volatilities of those options, can run 80, 90, 100% or more. So surely as an investment, it might have low volatility as a package, but I can't see it as being the greatest investment in the world in terms of owning something where you're going to hope to make long-term money with it.
Yes, that's why it's such a disconnect for me in that term low volatility, because you're right, in the individual components, they do have overall net lower volatility than if you just had, especially with the covered call portion. But once you add on that crazy VIX call, all bets are off from a low volatility perspective. I find it odd. Of course, I see the logic behind it. They're trying to take the two products they already have that are existing and probably haven't gained a lot of traction, and trying to merge them together to help drive the two and keep it in the family. Of course, and also market this to all these people we've been talking about on this show for ages and other shows on this network, the money managers, the asset managers, who should know more about this stuff but just don't. So if you can put it together in one easily digestible package, makes it easier for them to add it to their portfolios. I kind of wonder about some of the other aspects of this product overall.
Well, is this a better way to play compression, or a better way to basically buy a low VIX and the SPX underlying at the same time? I was a little torn there on if it's a smart way, because normally, obviously the best performance for any type of call spread or collar with a long underlying is a move up in kind of a slow manner.
That's right.
The fact that you're long, the only way that really makes this work is you really kind of have to be trolling around when the VVIX is very low, where this would look actually kind of appetizing, looking for a kind of an up move. I wonder how the index performs, though, when the market starts to right, if you're buying that call super cheap against your SPX, it actually might work out okay if things start to unwind a little bit. So basically, you're long. I think actually it only really works when the VVIX is really cheap as an entry point.
That would be my, I think, guesstimation. That'd be my estimation as well. And of course, we've talked a number of times on this show about how the very near-term VIX calls are the portion of that product where the disconnect between implied and realized vol is the highest. So you're paying the highest implied vol premium for those near-term products. I'd definitely like to see them maybe play with the structure a little bit and roll that call out perhaps 3 months. Not too far. You don't want to dive into roll risk land, but perhaps some midpoint between that, maybe 3 months out, is the ideal point for that. I know OIC has done a lot of research with collars on this, and they've determined that a 6-month put in the Qs at least, and a front-month collar is the optimal construction for that. So maybe a similar configuration for this that takes into account time decay as well as some of the unique aspects of the VIX product might make it a little interesting. Conceptually, I think we all can agree it's somewhat interesting. Perhaps implementation, not so much, but an interesting one nonetheless. This got a lot of attention last week. Of course, they announced that they probably name it something to do with the overwhelming media belief that we're in a weird low-vol environment. We've discussed that and debunked that many times already here on this show, so we won't go down that road again, but I'm sure that played into the relatively, shall we say, odd nomenclature used when naming this product. Moving on to some of the other comments here, we have a lot of people writing in about what we've been talking about Black Swans recently on this show, tail risk, how it's been priced in. Oscar wrote, this is actually about Jared Woodard's article we had posted on the show, and of course we discussed last week. He said, wow, it's a great article. Given the last episode of Volatility Views, this is very timely. When are you going to have Condor Options on the show? It seemed like they would fit nicely with Mark, Don, and Mark. And of course, we had that on the last episode, so Oscar, we missed you by a week, but hopefully you enjoyed last week's episode. I know Don and I certainly did, talking about that stuff. We also had another interesting comment about that. We had someone coming on our website, goes by the handle Asymmetric Risk, responding to some of the topics we discussed last week. And Don, I'm curious to get your feedback on this as well. He writes, I've never read any of Nassim's books, much less his research. However, I've probably traded more options with him than any of his other counterparties, going back to the 80s when we were the two most active currency options traders globally. I would describe him as a buyer of back spreads and very well positioned for gaps and jumps, many of which were not black swans per se. For example, the sudden 10% currency move we had when the Swiss National Bank put a floor on the euro recently. Your critique of his strategy was unduly harsh because while he is set up for black swans, he isn't dependent on them to be profitable as you guys characterize them. Well, thank you for... Yeah, we like this. See, we bring in even the contradictory viewpoints. I thought this was interesting for a couple of reasons. First off, we appreciate the feedback. This is interesting to have someone who actually traded with him and get their input. I think what Don and I and Jared as well, I won't speak for Jared, but we'll attempt to since he's not here, we're really trying to mention last week was the disconnect between a lot of the research and books that he's put out and his public media persona that he's created. And part of it is not his fault. The media has created this persona around him, but he, of course, has embraced it. So he definitely plays a part in that. Exactly. The Black Swan guy, the tail risk guy. Andrew, I don't know. You didn't hear last week's show. Let me put it to you. Stone cold right now. If you had to guess, and putting aside what asymmetric risk here says as well, if you had to guess right now, is Mr. Black Swan, is he a buyer or seller of at the money premium, at the money straddles? Which way would you think he leans on that side of the fence?
Well, I'd have to say buys them.
Yes, exactly. And that is the fundamental disconnect around which Don and I were puzzling last week, because Jared came on and he discussed his article from Condor Options, and he also had an interesting Twitter exchange with Mr. Black Swan himself. And at the end of that, he sent a very surprising tweet to Jared, a very direct message saying essentially, in all caps, I always sell at the money straddles. And that was really...
Buy the junk.
Yeah, exactly.
Yeah.
He didn't add that portion of it. I'm assuming that's what he does. But, Twitter is limited how much you can say. But that really blew my mind, and it got Don thinking as well. And we kind of led us to think that he's created this persona of really being net long premium for these extremely aberrant events and scenarios, and created this persona and written books about this. And then yet in his trading style, he seems to do something else. This person describes a somewhat different style of trading. Back spreads, where listeners, if you're not familiar, are essentially net long more contracts than you're short. So you're trading a ratio, might be 3 to 2.
Juice for nothing.
Yeah, exactly. That's Andrew's strategy as well. Buy the juice for nothing. Of course, that kind of contradicts the selling the at the money straddles. I'm not sure how that two I'm not sure how those two kind of fit together. But I think the issue we had with, and I think Asymmetric Risk, I would encourage you to do this too, go check out some of the books that he's been writing and promoting for the past few years, and then see if to yourself if that persona and that viewpoint that he's espousing in those books tends to jive with what you know of the man, as well as what you've seen here in his trading style. And then if you come back after reading those and think we were unduly harsh, I will, of course, accept your criticism. Don, what do you have to say about the comments from our friend here, Asymmetric Risk?
Well, it seems to me that it's perfectly possible that as a trader, you engage in more than one kind of position or more than one kind of trading, but the person writing may have seen one side of Taleb and been a counterparty and taken the other side. For example, if a person is looking to do a back spread, and let's say because of the Black Swan issue, he was looking to do it with puts to the downside, you would be basically selling a put with a higher delta and closer to at the money, and then you would be buying in ratio very often to farther out of the money, lower delta puts, so that you were net long one option, and then if you have some sort of catastrophic event, that option kind of provides all of the profits to the position. And it often is the case that you can put those on, as Andrew was saying, buy the juice for free, for not too much in the way of a debit. But, there really is no such thing as a free lunch, in the sense that it is undeniably true with the skew the way it is, that the options that you are buying, no matter what the actual debit is or the actual premium or the price of those options, you're paying up for them in the sense that you are buying two with a much higher implied volatility than the one that you're selling. So from, again, a mathematical point of view or an edge point of view, I really don't see making a living from using those kinds of positions where basically you're getting the worst of it in the options that you're buying, and you're not getting that same implied volatility for the option that you're selling. I surely wouldn't be speaking for Taleb, but if he saw the handwriting on the wall that this is probably not a way to make a living, and he said, so how can I put food on the table? And now along with these positions, I'll sell at the money straddles as well. It wouldn't necessarily surprise me. But then if overall his options trading is profitable, it's probably not from these back spreads, but from the other stuff that he's doing.
Exactly.
I remember, right after 9/11, I don't remember where it was, an article, if it was in the New Yorker or something like that. I could have sworn I read an article by him previous to that, because there was no small amount of volatility right after 9/11 too, in 2002 when Enron and all that stuff blew up. But I could have sworn I read an article where he's kind of dying on juice, and then 9/11 happened. And, obviously he totally cleaned up, because, that was the opening of all openings if you needed to sell some juice and buy the bottom that after the market was closed for the week. So I'm pretty sure, and I guess at the same time, I don't remember, there was that famous premium seller guy. I don't know if you guys remember his name in the early 2000s. He always seems to find money and then sell more juice, and then he blows out and does it again.
Is that Niederhofer?
Yes. That was the article, Niederhofer, and I believe I'm on 99% sure it was Taleb on the other side. And it was an article of the two contrasting styles after 9/11. I think showing the breakup of all that. So I think at that point, pretty sure he had some serious negative theta going on. So I don't know what the deal is now exactly, but that sticks out in my mind. Because I don't tend to read too much scholarly articles on all this stuff. I just tend to lean on my own experience of getting slapped in the head for 15 or 18 years. But it's it was an interesting of before actually he became the industry that he is now. Obviously, what that article was, back then. And if you search, I'm going to guess it was like around 2000 and posted 2001, late 2001, like December or early 2002, on that very same subject. So I don't know. I like the guy's writing, and I think people are. I think the biggest thing I think that's changed over the last 5 years is the concept of liquidity, which makes a lot of what he writes about, I think, a lot more. The movements when they move are much sharper, I believe, when they used to be when I first started. I don't know about Don because he's an old guy, been around for a while.
Yeah, ancient. I was sitting on the desk for the 87 crash. I just missed the 1929 crash.
I think you still have some tulip bulbs in your attic, don't you there, Don?
I was dating myself as well. I'm just, the 87 crash, obviously a huge event. But what I'm talking more is kind of the frequency of these shocks than they used to be. And then I think it's fundamentally the liquidity side of the picture has changed a lot, which is making these shifts more, more frequent. Now, am I wrong about that? I'm not sure, but that's just what it feels like to me. So
it may be, and I'm not really sure if you take a look from a percentage point of view. There certainly have been a few years recently where the number of whatever you want to define it, 2% moves on the day, or even greater, were considerably more numerous. Just counting them without going into the magnitude of how big beyond 2% they were a lot more frequent than they used to be. And that would be an interesting statistic to look up to see if in general the frequency of what you're calling a shock has increased somewhat over the years. But in this concept of our writer, just to finish this last point with back spreads, some people listening might be a little confused when we talk about juice for free, where you put these things on for no debit. That don't get confused and don't think that you can't lose money doing these spreads. The no debit part comes in if you're doing this with puts, that if the market goes up or stays where it is, you haven't paid anything, so you don't lose anything. There was no expenditure of premium. Now, that doesn't mean that all you can do is make money to the downside, because the shape of such a position, a put back spread, is such that when you've got that sold option, you sort of go into the trough. You have a V. You go into the well for a little bit, and until you climb out with a big movement to the downside, there's a rather wide area over which you would incur a loss if you simply put the position on and hold it till expiration. So don't think, for those of you who may be a little bit new to back spreads or aren't visualizing this, that the fact that you establish the position for no debit means that, either I lose no money or I make something. That's not of this world. There's lots and lots of ways to lose money with back spreads, and if you do that rather consistently, when your ship finally does come in and you make some money with a sharp down movement, the question is, have you eaten enough of the losses such that you're still in the negative? And that's where we come into expected value, and whether you have value with the premium that you're buying or not, and the overall expectation, as opposed to, let me point to the time where I had a big windfall.
Don, you're crushing me, Don.
The impact zone. I like to call that the impact zone of those positions, right? Where you have a ratio spread on, there's kind of a gap between the short and the long strike, right, and everybody looks at them like, oh, this is great. And I'm like, well, there is a part there where this slides away and it becomes super ugly for you. We would call that the impact zone. Yeah, your P&L is negatively impacted hugely.
There you go. There's another title for your book, Andrew. I'm just cranking them out for you today. My consulting fee will be in the mail shortly.
And Andrew,
hey, I'm coming up with them. You're
as you well understand, Andrew, as you well understand, that area is the area near to the sold option, which is usually close to at the money. And so when you have your bell curve and your normal distribution, or even a log normal distribution, you understand that the bulk of the probability of the price ranges hangs out in that area. Now, the upside doesn't matter because it doesn't enter into play, but it matters at least halfway on the curve for the downside, where you are winding up in that area with a good chunk of probability and with a great deal of frequency.
Yep, it's a big messy spot right there.
Don, you're disabusing me, Don, of my notion that there is a free lunch in the options market. You're telling me that there is no literal free lunch. I have to go back and change all my trades right now. I've been doing it all wrong all this time.
Undo it. Unwind everything.
Yes,
is
there an untrade button on my screen? But I'll just say this to finish up the Black Swan discussion, then we'll table it until we get some more comments on this, which I'm sure we will. I would just say that if we were criticizing him, it was because, quite frankly, we saw a pretty surprising disconnect between what he's been espousing for many years, back since 9/11 and even before, and in his books and everything else, and what he seems to be doing and saying privately. This was a private conversation on Twitter, as private as Twitter can be. But so there seems to be a very clear disconnect there, and that's all we were really saying on the last show. Is that kind of took us by surprise, and perhaps there is something else going on there beside what he's been saying and espousing and taking credit for all of these years. As Andrew said, he seems to pop up whenever these big events show up to say, hey, look, my strategy of buying premium actually works in these crazy events, and he goes away for quite some time until the next one shows up. So that's all we'll say on that. Moving on.
Sounds like a good business.
Yeah, not bad. And he makes some nice money on books and speaking fees and some Black Swan tchotchkes in the meantime. I'm sure there's some Black Swan figurines on some trader's desk somewhere. And
see, that's what you need on the Option Insider Radio Network. You need
We're missing the tchotchkes. We're missing the tchotchkes.
Black Swans. Well, you need juice, where people can go buy juice at the juice store.
You kidding that? We need a little options logo guy for everyone to pick up their Options Insider look. That's all coming.
Don't sell them T-shirts.
There you go. There you go. See, now you guys are thinking. I'll put you guys to work on my marketing team after the show. I like it.
Don says sell everything all the time.
All right, we'll close up with a quick email question here from Mark S. I guess Mr. Sebastian is writing in when he can't be on the show. I didn't say where this one is from. I didn't see if it was Chicago. That'd be pretty funny. But he says, should I even pay attention to the Vega numbers when trading weekly options? It seems like vol is mostly irrelevant in such a short-dated option, and that any measurement of that vol would be highly prone to error. Weeklies seem to be gamma/theta B, so that's where I expend the bulk of my effort and analysis. And in quick summarization, I would say, yes, you're pretty much right. That's where you should spend the bulk of your analysis. Weeklies are gamma and theta beasts, and if you don't pay attention to what gamma and theta can do to you with those contracts, everything else is essentially moot. Gamma can overwhelm anything else in those contracts, and so with such a short time frame, you really have to be cognizant of the impact of that. And if you start looking at Vega levels, they have some relevance, but you're right, they're not that accurate in such a short-dated contract. A lot of platforms don't do that well, really giving you a solid
think
Vega.
About the relative numbers. Right?
Exactly.
The relative number of Vega as a risk is very small. The relative number for your gamma versus theta is real big, right? So that's when the model flip-flops between how important is volatility as an input, how important is the underlying price as an input. So you're pushing up at the maximum there. So that's but that shows a pretty good understanding of the Greeks, I would say. I think he's right.
I think he is right. That those were the contracts were back when it was only monthly contracts, back in the dark ages, Andrew and Don. And every month you'd get to that expiration week, and that was the moment when you essentially would throw your model out the window because your gamma would be exponential, your theta would be exponential, and everything else was kind of meaningless. And now you're trading a contract that is naught but expiration week, so it's nothing but gamma and nothing but theta. So you're just doing that same thing every week. So just bear that in mind.
Now that they started listing the products, you could buy weekly time spreads.
Exactly.
You have risk, but nothing like when you're just selling a naked weekly.
Don't say the B word around Don, but you can execute execute spreads with a long component, let us say.
And still collect theta.
Yes, there you go. Best of both worlds. Free lunch.
I think what the writer means here, and you've already said that is absolutely correct, is that when you have options that have relatively low prices and are going to be going out, expiring in such a short period of time, relatively small price changes can, therefore, when you back out through the model, imply vega or implied volatility changes that are appreciable. So you look at something and you say, wow, that's a 50 or a 60 implied volatility, but usually they don't play around with models to see that if you change the price by 15 or 20 cents, the implied volatility would drop to a much lower level. And actually, this was the concept historically when you go back before the crash, and everybody talked about the volatility smile as opposed to the skew that we had today. Basically, there was not only no skew at all, but really for all intents and purposes, it was a one implied volatility fits all, and it was almost kind of like a straight line through strike prices across the board, both below the market and above the market. So the question was, how did you ever get the smile? How did you kind of get the upturn of the lips on the downside or the upside to fashion anything that would look like a little bit of an up curve or a smile? And the answer was simply that when you had these far out of the money options and they were supposed to have a Black-Scholes value of 2 cents or 3 cents or 4 cents, but we couldn't trade them that way, and you traded them at a 16th, which was 6 cents. All of a sudden, 6 cents was double the price of 3 cents, and the implied volatility was several points higher than all the other ones. Or if you, God forbid, you traded it at an eighth, and now it was 12.5 cents, but it was supposed to be worth only 2 or 3 cents. That looked like it had a tremendous implied volatility, but price-wise, you were talking about a couple of pennies. So that's how the smile was born, and that's why you had anything that even looked like it had any curvature at all. Otherwise, they would have been perfectly straight line, all of this before 1987.
All of this before the great tulip crash of 1987.
Exactly. The days of light and fun.
Yes.
Oh, Ronald Reagan days.
Yes,
25
exactly.
years ago, quarter of a century. Pretty hard for me to believe.
Hard to believe, Don. Hard to believe indeed. And I think with that, we're going to have to close out the old mailbag for this week. I apologize if you wrote in and we didn't get to you. We will get to you on a future show. But now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. And people write in to say, why do you have such sad music for the Crystal Ball? And I say, because it's the final segment of the show. So we're all sad that we're getting close to the end. But before we go, we have one final thing to do. And that is, of course, to peer deep into the murky ether of the future to attempt to divine what the volatility gods hold in store for us for the coming week. I think we'll mix it up today. Don, how about we dive into NASDAQ land first? How does that sound with you?
Yeah, I'm fine taking a stab. When we get to these kinds of levels and you see this kind of complacency, even with the down move of Apple, I almost shudder to think what would NASDAQ volatility be if Apple had not been on this slide recently, probably even calmer than what we were discussing earlier today. So you do come to a point where you say you just kind of wonder how much lower can it go. But I'm not going to fall into that trap, because I honestly do feel that we are at a traditional time of the year when there is very little volatility, and where in the old days, we used to talk about window dressing and the January effect, and large cap outperforming small cap, and the Santa Claus rally and all of those things. A lot of that's been put on the back burner when we have been talking recently, because everything seems to be dominated by Washington and the fiscal cliff and what might happen in the next couple of weeks. So they're almost contradictory points of view, but this is a very difficult time in which to try to predict future volatility, be it of the implied or the realized kind, because you do have this event kind of hanging over everybody's head. And till it's resolved, where volatility goes is going to be almost completely dependent on how this issue finally gets settled. So you take a stand one way or another, and then you predict volatility on the basis of what you're predicting is going to happen, because that's going to be the sole driver of the result and whether you're right or wrong.
I think you get a pass for the next few weeks there, Dan, or Don.
Yeah, that's a pass.
An easy pass for you, Don. So don't worry. I don't think our listeners will hold you too closely to those ones, because you're right. We're not exactly in a fundamental or even a technical period or anything like that. It's all just what goes on in the smoke-filled rooms of Washington. Andrew, I'm guessing you might have something similar to say.
Yeah, I mean, we're a 16 VIX if nothing happens, because I don't believe there'll be any natural sellers of premium and size in that Jan cycle right now where the VIX is. So who's selling it? No one. So, we are stuck here until they come up with something, but I believe we'll have one solid panic when everybody just gives up on those nabobs from both sides and says, we're all doomed anyway. So I say we will have one vol shock between now and the end of the year.
You know, it's kind of interesting, Andrew. At this time last week, we were talking in similar terms, and yet we were noticing that VIX was up on the day, and talking about the fact that, at least I speculated, that the weekend effect was kind of canceled for last week because of the overriding concern for anything that could happen with the fiscal cliff and what might happen over the weekend. And so people were taking the opposite point of view, and VIX was actually a point or 0.95, something like that, higher as we were recording the program. Well, not a heck of a lot has changed. I don't think you could say anything optimistic happened this week. And so we're closer to the deadline. If anything, I might have thought that the same type of sentiment would prevail, and that you'd see similar activity, but it's nothing of the sort. VIX is actually down about a couple of tenths of a percent and 0.34 on an absolute value. So none of that weekend sentiment that we saw last weekend seems to be carrying over to this weekend.
No. Well, we did have the unemployment report did come out. That's one piece that's been a market mover recently. I mean, it didn't move it today, but so there's one piece of uncertainty that's out. But yeah, they're definitely not, at least as of right now, they're not putting the weekend back in. So, ultimately too, there is some fatigue going on. I think the day-to-day of not really seeing any positions change, people just get numb to the same old thing every day. But that doesn't mean that there won't be one day of screaming panic, which I would not spend a lot of money on that, but I have a hard time believing we don't get at least one.
Now, I think the market seems to be agreeing with you to a degree, Andrew. I think the closest analogous situation we can look to for what we're looking at here with the fiscal cliff was last October, or October of last year, I should say, with the debt ceiling debate. And everyone at that time was essentially deciding that regardless of the outcome, there was going to come to some decision before the deadline, so there would be a compromise. So everyone was betting heavily on downside and vol coming out of that event because they thought it was going to come off in droves. Of course, you saw what happened there. Shortly after that announcement, the downgrade came in and the vol went through the roof, and everyone got crushed who put on that trade, or they had to roll it for months before they got anything out of it. So maybe some people were burned by that, and so they're taking a more wait and see approach on the fiscal cliff.
The scars are
are still fresh. Or also maybe they agree with you too that there's going to be one, maybe two shocks before we get everything settled out, and so they don't want to lean too heavily in one direction or the other until everything kind of gets settled out. Maybe a combination of the two.
Yeah, and don't underestimate Apple. The vol is now in Apple up one. The Apple VIX is up 173. If Apple really falls out of bed and really starts making people unhappy, it's just like I was saying earlier. It doesn't take much to move the market for very short amounts of time, very fast anymore. So, that's kind of where I am on that whole thing.
Yes, we are in the thin part of the year, so bear that in mind as well. All right, thank you for that. And unfortunately, listeners, that's going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. But before we go, I like to check in with my co-hosts here, my cohorts, my partners in crime, to see what they're working on that may interest you the listener. Starting off with you, Andrew, what is coming up in the land of the pit that may intrigue our Vol Views audience?
The month of December is relatively quiet for us. All of our January classes are close to filled up. I think we have 1 or 2 more spots. I don't believe we have any more events in January. I was just looking at our website to make sure. But other than that, it's kind of quiet here. And we still, of course, have, if you like the stuff you hear here, there's always the Pit Report that you can always try for free for a month at Option Pit, where we walk through volatility, walk through the markets and what's going on and what's really causing the volatility to change, generally midday. And that is available. So just go to www.optionpit.com and surf on over and check it out and watch Mark and I look at stuff live.
All right, thank you for that, Andrew. And of course, Don, as always, we also like to check in with what's going on over at volex.us. You guys have been teasing us with a number of large announcements coming down the pike. Is any more progress on those or anything to unveil over at volex.us, Don?
Well, not to unveil, but yes, definite progress and continuing negotiations and another big meeting on Monday, and so it goes. In the interim, Bob Kraus, the CEO of the Volatility Exchange, and I have been kind of busy doing something which may not be immediately transparent to our listeners, but we're tightening up some of the nomenclature and how we refer to our various products and concepts, and we've made some changes that we think just kind of put them more in line with the realized volatility brand and kind of make things a little bit clearer as we refer to different products. So it's a rather large task when you decide to make a fundamental change like this, to go and find every document that you've ever written, every page of the website, all references to these staple products, and kind of update them and bring them around to the new way of thinking. So we've been busy doing that, and we'll roll all of this out on the website very shortly, and then perhaps we'll discuss a little bit more in terms of why we've done it and what our reasoning is on future shows.
All right, thank you for that, Don. And that is going to do it for this episode of Volatility Views. Of course, if you'd like to learn more about any of the topics we discussed on today's show, or if you'd like to join some of your fellow listeners who had a chance to chime in and contribute to today's show, then surf on over to theoptionsinsider.com, where you can post your comments on this or any other content on our site. You can listen to this episode or all of the previous episodes of Volatility Views, as well as all of the other programs on our Options Insider Radio network. Of course, you can reach out to us a number of other ways as well, via Twitter. We're at Options on Twitter, via Facebook. Just search for Options Insider, or of course, just shoot us an email, questions@theoptionsinsider.com. Just put question for Volatility Views in the subject line so we know which show you're referring to. And before we go, all of us here on the Volatility Views panel would like to thank all of you out there in the listening audience for downloading and streaming and subscribing and indeed contributing to our Volatility Views program. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.